Okay, so I just wanted to review this trade I took on the USCAD on Friday the 17th of April. I thought this might be a example that might be useful to some people, and they might relate to it. It's a losing trade. My general trading style is to trade intraday. I look to capture 20 to 30, sometimes more pips on an intraday basis. I'm in and I'm out of the charts inside a day generally, but occasionally I'll see these sorts of swing trade ideas come up, and they can often form an extra, an extra little piece of the pie in my strategy. So what I was looking at here on the USCAD, we've been moving lower quite, sort of actually fairly choppily lower on the USCAD. For the last month and a bit, since March. And we're breaking out. You sort of got this downwards trend line. That's just to show sort of the downwards momentum of the market, and we've broken out of it. Formed this high in here, come back down, and there was a potential with this. If it was going to keep moving higher, in my opinion, we would have bounced off these highs, or this area would have bounced from here and pressed higher. We didn't. We gapped down. Broke this smaller intermediate term swing low in here, and we even failed to bounce back off. There's a support level in here that we bounced off here and came down again, runs up, runs the high, and breaks down, gaps down, breaks down again, and then starts pressing back up on this 4-hourly candle. Now I was looking. The idea was that we might press back up into this area and then get another leg down to retest the backside of this trend line, potentially into these these old lows, potentially sort of 200 pips of range. There's about 100 pips of risk from a swing trading perspective. So I flipped it down to the hourly chart, and as we pressed up in this candle here, I took a short. Again, the idea being it was a swing trade, and I was looking to hold it for potentially, 1 to 2 weeks, or a few days to a week, I guess, and look to get a press down into this area. If we started to bounce off these old highs, then I'd probably pull it there with around 150 pips, and if it kept going down into 200, then I'd look to take that. So I duly entered a short with the appropriate risk for 100 pips risk, 200 pip target. And then entered the short. Now then, at the same time, I was trading. I was short on the pound USD. I was short. I had a short bias on the Euro USD. I didn't have any trades on, but I had a short bias on the Euro USD, which means that I had a long bias on the US index. So if we look at the US index chart, it actually pressed down and it bounced off this 4-hourly chart. There's a bit of a trend line we're forming in here. We bounced off it. We pressed up strongly. It looked like we were going to come up and break this high. At the same time, intraday, I had intraday shorts on, like I say, pound USD and a short bias on the Euro USD. So I was long US dollar, potentially short currencies. So the US CAD was screaming up here at a rate of knots, and I thought maybe the thought process, obviously I'm intraday trading these other pairs, and I think that impacted my swing trading trade on this trade. There's a few things I could have done and potentially should have done, and one of them was to look at the Fibonacci retracements on this overall swing and look for a potential pullback to the 61% retracement. I mean, that hits the high perfectly. Or at least a 50% retracement could have been an entry point on this swing back, pullback, rather than getting in so early on the retracement. I potentially could have waited and either put a pending short at the lows here in case it did fall from this level. But in terms of this range high to low, getting in below the 50% level actually goes against many basic sort of principles that I would follow. So that I believe was a mistake, and that was potentially playing on my mind as this. Although it wasn't an actual consideration, I didn't even draw the fibs on it. I didn't even think of doing it until now. But there's one potential mistake, or something that led to a trade that has turned into a loss for me that shouldn't have. I mean, my stop was up here, and it came nowhere near it. But as this candle screamed higher, the US index was looking strong. My shorts on the pound, I'd actually just taken profit at that time. Took sort of 40 pips or something out of that market, and this is screaming up 50 pips against me. And so then as this candle pulled back, I thought we might, form a pullback and then press higher. I even dropped this chart down to a 15-minute chart, and you can see here we're making higher highs and higher lows, higher highs. We're looking like we're going to make a higher low in here and then press higher, which on a 15-minute chart it did actually do, and then it failed. But by the time it failed here, it came up here actually for a re-entry on a short. But by the time it did that, I was in bed. So I missed the entry on a retest. This would be your perfect lower time frame if you wanted to take that higher time frame idea and come down and trade this. And this is how I would normally trade on a you see a move like this and then you get a perfect response up to 61.8 or 62% retracement level. With all the higher time frame structure that I was describing going into it, and then you get this reaction lower, you get pressed back up into the old lows. You expect a higher low here, press up, make a higher high, higher low off these. We break that intermediate or lower term low. And then come back up and press back into it. That's a perfect place there to enter a short. And while it's below 50% of the overall range, in terms of your range from this swing high to this swing low, you're above the 50% area of that level. So in terms of that area, you're actually entering above the 50% area. So you are, that would meet my criteria from that point of view. But of course I was in bed by that stage, so I was in front of the charts. I wasn't looking at this from the point of view of getting an intraday entry on the position, although that might have suited my trading style better. I was looking at it from an hourly or 4-hourly chart, and I was looking to take a swing trade with a 100 pip stop for a 200 pip target trade. However, the decision to go in and micromanage the trade on an intraday basis was a mistake. It was led, in part by the fact that I was trading other pairs on an intraday basis on the same platform. Now, had I held that trade, it would currently be in profit. Price did rally up there and flip over and drop. The entry wasn't the best entry in terms of what could have been gotten. I mean, I could have had an entry here at the 50% or even better at the 61% retracement. That would be you could even backtest that as a setup in terms of looking for these situations where you have a press higher, a consolidation, and then a failure to break higher and a clean break of the swing low. These sorts of setups, you need to make sure that the consolidation prior to the swing high forming needs to be broken in one clean, swift movement. And then you can get a press back up to the 61.8% retracement, short there with targets down to the 161 or 121 would be potential, or you could have an overall target with a 200 extension, and that will line up with hitting the backside of this trend line, along with running this old low. If you think about it in terms of market orders, where are the orders going to be? Anyone who's long, who got long in this area, they're going to have their stops below the low here, or they may have trailed their stops up to below this area here, but there's still potentially going to be a pool of market orders below this low. You'll also have people on the higher time frames, 4 hourly. You potentially have, there'll be funds and that sort of thing that'll put short sell orders below this low for a breakout trade to resume this downtrend. On a failure of the uptrend, then they'll look for short orders there. So there's plenty of reasons for liquidity to be below this low, and the market to return to that area. And from a higher time frame perspective, that's my belief that we do have a opportunity to go down there. We have closed below this low, and it'll be interesting to see how we open on the weekend. From a 15-minute time frame perspective, we could see a bounce back up above these highs. There's relatively equal highs in here. Anyone who got short in this area may look to bring their stops down above these highs. We may get a press back up into that area. I don't really want to see these highs give way, and I definitely don't want to see this high give way. But if we can press back up in here and form a swing high and reject these highs and look to break down, I might look for a lower time frame entry in this on Monday. If we gap down, then I'll look for a retest of these lows and look to get short off that. And again, I'll be targeting this area and lower. If we gap down and retest, I'll probably get short and I'll look for stops above these highs in here. This is an overall consolidation area. You could box that area out like that as a, oops, then all the candles disappear. If we set it up like that. So there's the consolidation, there's a spike above it, reconsolidation inside it. If we get breakdown below it, retest it, stops above the consolidation, target the low, that would give us, if we got, say we got an entry in here, that would give us a 50 pip stop for potential 100 to 150 pip target. So that is an idea that I'll be taking into next week. I am disappointed that I pulled the trade as I did there. There's a few things that if you're struggling, if you find you're doing the same thing, there's a few things you could do. If one style of trading is impacting another style of trading that you feel you can have in your arsenal, I could open a secondary account for swing trading only, and swing trade that, and then open these types of trades on a separate account. So you open the trade, and then you walk away. You close them up, you close it down, and walk away. Or you can just be disciplined, and potentially I could have been more disciplined with my entry instead of jumping in as I saw this spiking up. I could have, if I'd waited or placed the fibs on and actually thought a bit more about the entry. The trade was taken almost on a spur of the moment. I flicked over to the H4. I was looking through pairs, looking for opportunities for the day, and I was looking at the pound, and I was short pound in here. And well, actually, pound was bouncing up in here as the USCAD was sort of it rallied up in here, and I felt it was possible we were going to retest this pivot line and then go higher. But I was waiting to break this high, which it never did. But the point is, I was trading these other pairs on an intraday basis, and then that sort of flicking over the USCAD, I saw this. I thought, hey, there's a good opportunity, and I jumped in. Without really completing my analysis from a swing trading point of view on the trade, and I think that was potentially a mistake as well. So I'm just throwing this out there as something that other traders may come across the same thing when they make a mistake, when they make mistakes like this. It's good not to. It's not the end of the world. There's still potential to get in on the back of this trade, and I can still make plenty of money. But it's important to stay disciplined with your trading plan and your setups, and not to and to learn from your mistakes. So hopefully that's of use to someone out there, and I'll pop this up and talk to you next time.